Welcome to the third episode of our price action course. Today, we are diving into the heart of market trends. Imagine you are journeying through the stock market with three companions: a long-term investor, a swing trader, and an intraday trader. Each one views the market differently, based on the time frame they are focusing on. Ask them about the current trend, and you will get different answers. The investor says, bullish; the swing trader sees a sideways market, and the intraday trader spots a bearish trend. Why? It all comes down to perspective, the different time frames they use based on their trading strategies. When you change the time frame, your view of the market trend can change too. A trend is just the market's overall direction over a certain period. We have 1. Short-term, 2. Mid-term, 3. Long-term. These trends are further categorized by time frames and can influence how traders perceive the market. In the stock market, we typically see three types of trends. 1. Uptrend, the market is moving upward. 2. Downtrend, the market is moving downward. 3. Sideways trend, the market is moving within a narrow range, without any significant upward or downward direction. So, how do you identify these trends? That is where trend lines come into play. Drawing trend lines are crucial because they help you spot the overall direction, whether the market is climbing, falling, or just drifting sideways. But here is a twist. Within these trends, there are price swings. Think of them as the market taking a breath. When the price swings upwards strongly, it is called an impulse move. This is where the market shows its strength. After that, a corrective move often follows, a slight dip as traders take profits, but the trend continues. Recognizing these swings helps you decide when to ride the wave and when to hold back. In Elliott wave theory, impulsive waves follow the trend, driving prices up in uptrends and down in downtrends. Corrective waves move against the trend. Impulsive waves are stronger and more aggressive, often with larger candlesticks. Recognizing these waves helps you predict the market's next move and stay on the right side. Let's dive deeper. A higher high happens when the price peaks above the last high, showing an uptrend. A higher low forms when the price dips but stays above the last low, meaning selling is slowing down. On the flip side, a lower high shows a weak rise, and a lower low signals a downtrend when the price drops below the last low. Higher highs and lows signal an uptrend with rising value, while lower highs and lows indicate a downtrend and decrease in value. Now, we have reached the key part of this lesson. Using higher highs, higher lows, lower highs, and lower lows, we can draw a trend line. Connect at least 3 points to make it valid. After each price rise, it often touches the upper line and then falls, stopping at the lower line. This repeats until a breakout or breakdown happens. Why does price follow trend lines? Price movement within trend lines is not a magic. It is the result of supply and demand, along with support and resistance levels. We will explore these concepts in detail in upcoming episodes. To get better at using trend lines, remember: 1. Professional traders use indicators like moving averages, ADX, to confirm trends. 2. Pay attention to the angle of the trend line. If it is less than 30 degrees, a trend is too steep and unstable. It's better when the trend's angle exceeds 45 degrees. And 3. The more times a price touches a trend line, the stronger that trend becomes. As we wrap up this episode, practice drawing trend lines on your charts. Start paper trading by buying when the price begins an impulse move from the lower trend line and selling when it touches the upper trend line. Thanks for joining this episode of the Price Action course. Stay tuned for more insights in the next episode, where we will continue our journey into the world of market dynamics. See you next time.